Right now, your brain is lying to you about money, and you have no idea. If you've ever wondered why saving for retirement feels impossible, why you consistently underestimate how wealthy you could become, or why the richest people seem to follow completely different rules than everyone else, what I'm about to share will explain everything. In the next 50 minutes, you'll understand exactly why your mind cannot grasp exponential growth, why compound interest feels like magic instead of mathematics, and most importantly, how to finally align your thinking with how wealth actually works. But first, I need to tell you about a simple question that reveals the deepest flaw in human reasoning about money. Whether you're fully focused right now, or simply letting this play in the background while you work, rest, or drift to sleep, your subconscious mind is listening. The gentle frequencies woven into this audio are designed to quietly reprogram your relationship with money and abundance. So there's no need to concentrate. Just relax. Let the words and frequencies do their work. Your mind will absorb what it needs. Here's the question. If I offered you a penny today and promised to double it every day for a month, would you take it? Or would you prefer I just give you $1 million right now? Most people, when presented with this choice, immediately reach for the $1 million. It seems obvious. A penny versus $1 million? No contest. But here's what your brain cannot see. That penny, doubled daily for 30 days, becomes over $5 million. Day 1, 1 penny. Day 2, 2 pennies. Day 3, 4 pennies. Nothing impressive yet. By day 10, you have about $5. Your linear mind says this is going nowhere. But exponential growth doesn't care what your mind thinks is reasonable. By day 20, you have over $5,000. By day 25, you have over $160,000. And on day 30, you collect over $5 million. This isn't a math trick. This is compound interest. This is how wealth actually grows. And this is why your brain, evolved for a world where more food today meant survival tomorrow, cannot intuitively grasp how money multiplies over time. The linear mind and an exponential world, we live in two different realities simultaneously. There's the world our brains evolved to understand, a linear world where effort equals reward, where cause and effect happen quickly, where you can see the results of your actions within days or weeks. And then there's the world where wealth actually grows, an exponential world where small actions compound into massive results, where the most important effects are invisible for years, where patience isn't just a virtue, it's the only strategy that works. Your ancestors survived by thinking linearly. If they found 2 berries today and 3 berries tomorrow, they could reasonably expect 4 berries the next day. If they walked 10 miles and found water, walking 20 miles might find them twice as much water. Linear thinking kept them alive. But linear thinking will keep you poor. Daniel Kahneman, the Nobel Prize-winning psychologist, spent decades studying how humans make decisions under uncertainty. One of his most profound discoveries was what researchers call exponential growth bias, our systematic inability to understand how things grow over time. In study after study, people consistently underestimate exponential growth. When asked to predict the results of compound interest over decades, even educated adults get the numbers wrong by factors of 10 or more. Not small errors, massive miscalculations. But here's what makes this particularly devastating for your financial future. This isn't just an academic problem. This bias shapes every financial decision you make. When you look at your retirement account and see it's grown by 8% this year, your linear mind processes this as small progress. 8% doesn't feel like much. It certainly doesn't feel life-changing. Your brain cannot see that 8% annual growth turns $10,000 into $215,000 over 40 years. It cannot grasp that the difference between starting to invest at 25 versus 35 isn't just 10 years. It's often hundreds of thousands of dollars in final wealth. This is why most people quit investing too early. This is why they cash out their retirement accounts during market downturns. This is why they choose immediate gratification over long-term wealth. Their brains are telling them the truth about linear growth, but lying about exponential reality. Consider Sarah, a 30-year-old teacher who starts investing $300 per month in a simple index fund. If she maintains this for 35 years at an average return of 7%, she'll have over $800,000 at retirement. But Sarah's brain doesn't see $800,000 when she looks at her account after 5 years and sees $18,000. Her linear mind sees slow progress. It whispers that at this rate she'll never have enough. It suggests she should try something faster, something more exciting. Meanwhile, her colleague Mark waits until he's 40 to start investing, thinking he'll just invest more to catch up. He invests $400 per month, more than Sarah, but for only 25 years. Mark ends up with about $400,000 at retirement. Sarah's 10-year head start, investing less money, results in twice Mark's wealth. This is exponential growth. This is compound interest. And this is invisible to the linear mind. The patience paradox here's where the psychology becomes even more complex. It's not just that we can't see exponential growth. It's that exponential growth requires exactly the kind of patience that feels unnatural to human beings. Psychologist Walter Mischel's famous Stanford marshmallow experiment revealed something profound about human nature. Children who could delay gratification, who could resist eating one marshmallow now to get 2 marshmallows later, went on to have better life outcomes across virtually every measure. Better grades, better relationships, better health, and yes, better financial outcomes. But here's what the marshmallow experiment really revealed. Patience isn't natural. It's learned. And most of us never learned it when it comes to money. In our modern world, patience has become even more difficult. We live in an economy of instant gratification. Food delivered in 30 minutes. Movies streamed immediately. Messages answered within seconds. Our brains are being trained for immediacy, while wealth building requires the opposite. This creates what I call the patience paradox. The very skill most necessary for building wealth, the ability to delay gratification over decades, is becoming rarer in a world designed for instant satisfaction. Think about your own relationship with waiting. When you invest money, how often do you check your account balance? Once a week? Daily? Some people check multiple times per day. Each time you check, you're asking your linear brain to make sense of exponential growth. You're asking it to feel good about progress that doesn't look like progress. You're essentially asking your ancient survival programming to get excited about something that won't pay off for decades. This is like asking a sprinter to get motivated about a marathon they won't finish for 26 miles. The sprinter's body is designed for immediate, explosive effort. The marathon requires something completely different. Your brain is the sprinter. Compound interest is the marathon. Warren Buffett, perhaps the most successful long-term investor in history, has said that his favorite holding period is forever. Not because he's patient by nature, but because he's learned to think in exponential terms. He's trained his mind to see what linear thinking cannot see. When Buffett bought Coca-Cola stock in the late 1980s, he wasn't thinking about what it would be worth next year, or even in 5 years. He was thinking about what it would be worth in 20 or 30 years. He was thinking exponentially. That investment has grown by over 1,500%. Not because Buffett is smarter than everyone else, but because he learned to overcome the linear bias that causes most people to sell too early. The compound interest blind spot. Let me share with you the most dangerous misconception about compound interest. Most people think compound interest is about earning interest on your interest. That's technically correct, but it misses the deeper psychological truth. Compound interest is about time amplifying small differences into massive outcomes. Richard Thaler, another Nobel Prize winner in behavioral economics, identified what he calls mental accounting, the way people categorize money differently based on its source or intended use. But there's another kind of mental accounting that's even more destructive: temporal accounting. Temporal accounting is how your brain values money differently based on when you'll receive it. Money today feels real, tangible, spendable. Money in 30 years feels theoretical, distant, almost imaginary. This isn't just about impatience. This is about reality perception. Your brain literally perceives future money as less real than present money. Neuroscience studies show that when people think about future rewards, different parts of their brain activate than when they think about immediate rewards. Future you isn't just distant. Future you is literally processed as a different person by your brain. This explains why it's so difficult to save for retirement. You're not just asking yourself to give up money today for money tomorrow. You're asking yourself to give up real money today for imaginary money, for an imaginary future person who happens to share your name. But compound interest doesn't care about your brain's perception of reality. It operates in mathematical time, not psychological time. Consider two friends, both 25 years old. Jessica saves $2,000 per year for 10 years, then stops completely. David waits until he's 35, then saves $2,000 per year for 30 years. Jessica invests $20,000 total. David invests $60,000 total, 3 times as much. At 7% annual returns, Jessica ends up with over $500,000. David, despite investing 3 times as much money, ends up with about $400,000. Jessica's 10-year head start overcomes David's 30 years of higher contributions. This is the power of exponential growth. This is why starting early matters more than starting with more. But here's the psychological tragedy. David's approach feels more reasonable to most people. Waiting until you have more money, until you're more established, until you can afford to invest larger amounts, this makes sense to the linear mind. The linear mind says, I'll wait until I can invest $500 per month instead of $100 per month. 500 is 5 times better than 100. But exponential reality says, starting 5 years earlier with $100 per month will often beat starting later with $500 per month. This is the compound interest blind spot. We see the size of our contributions, but we can't see the size of time's contribution. The psychology of exponential disbelief. There's something even deeper happening here. It's not just that we can't calculate exponential growth. It's that exponential growth violates our sense of fairness, our intuition about how the world should work. Albert Bartlett, a physics professor who spent decades studying exponential growth, observed that the greatest shortcoming of the human race is our inability to understand the exponential function. But I think he missed something crucial. It's not just inability, it's disbelief. Deep down, exponential growth doesn't feel fair. Think about it. Why should someone who started investing 10 years earlier end up with twice as much money, even though they invested the same amount? Why should the last 10 years of compound growth often exceed all the previous years combined? Why should small differences in timing create massive differences in outcomes? This violates our linear sense of justice. We believe effort should equal reward. We believe fairness means proportional outcomes. We believe that if you work twice as hard, you should get twice as much. But exponential growth says that working slightly smarter can matter more than working much harder. It says that timing can matter more than effort. It says that patience can matter more than intelligence. This creates what psychologists call cognitive dissonance, the mental discomfort we feel when reality contradicts our beliefs. And when faced with cognitive dissonance, humans have two choices: change their beliefs or deny reality. Most people choose to deny reality. They tell themselves that compound interest is too good to be true. They convince themselves that the stock market is rigged. They decide that wealthy people must have some secret advantage, some unfair edge. Because accepting exponential reality means accepting that the world doesn't work the way our brains think it should work. It means accepting that small, boring, consistent actions can create extraordinary results over time. And for minds evolved for immediate cause and effect, this feels impossible. Dr. Hal Hershfield at UCLA has conducted fascinating research on how people relate to their future selves. Using virtual reality, he showed people aged versions of themselves and measured how this affected their financial decisions. The results were striking. People who could vividly imagine their older selves were significantly more likely to save money and make better long-term financial decisions. But here's the key insight: they had to be trained to see their future selves as real. Without intervention, future you remains a stranger, and you don't make financial sacrifices for strangers. This is why compound interest feels abstract. You're not just investing for your future. You're investing for someone your brain doesn't recognize as you. The linear trap. Let me tell you about the most expensive mistake your linear brain makes. It's not just underestimating compound interest. It's overestimating linear alternatives. Your brain looks at compound interest and sees slow progress. Then it looks at other options: starting a business, buying real estate, trading stocks actively, and sees faster progress. But here's what linear thinking cannot see. Most alternatives to compound interest aren't actually linear either. They're exponential in the wrong direction. Starting a business has exponential risk. Most businesses fail completely, creating exponential losses. Trading stocks actively has exponential costs. Fees, taxes, and mistakes compound just like interest, but against you. Meanwhile, your brain perceives these risky alternatives as more linear, more controllable, more directly connected to your effort. You can work harder to make your business succeed. You can study more to become a better trader. Effort feels like it should matter. But compound interest doesn't care about effort beyond the initial decision to start. It doesn't care if you're smart or hardworking or deserving. It just cares about time and consistency. This feels wrong to the achievement-oriented mind. We've been taught that success comes from effort, intelligence, and skill. The idea that passive patience could outperform active effort challenges everything we believe about how success works. Consider the psychology of someone who's been investing in index funds for 5 years. Their account has grown steadily but not dramatically. Meanwhile, they hear stories about people making fortunes in cryptocurrency, or flipping houses, or starting successful YouTube channels. Their linear mind says, "Those people took action. They made things happen. I'm just sitting here letting my money grow slowly." What their linear mind cannot see is that most of those success stories are survivorship bias. For every person who made a fortune in crypto, dozens lost money. For every successful house flipper, many others lost their savings. For every successful YouTube channel, thousands never gained traction. But compound interest doesn't have survivorship bias. It works for everyone who gives it enough time. It doesn't require talent, luck, or perfect timing. It just requires patience. And patience, in our culture of hustling and grinding and making things happen, feels like giving up. The exponential mindset. So how do we overcome millions of years of linear evolution? How do we train our brains to think exponentially? The answer isn't to fight your linear instincts. The answer is to work with them. First, understand that exponential thinking isn't natural. Even mathematicians and economists who understand compound interest intellectually still struggle with it emotionally. This isn't a personal failing. This is human nature. Second, focus on systems rather than outcomes. Your linear brain wants to see progress, but exponential progress is invisible for most of the journey. Instead of checking your account balance obsessively, focus on the system. Are you contributing consistently? Are you staying invested through market volatility? Are you avoiding the temptation to chase faster alternatives? The system is linear. Contribute the same amount each month. Stay invested. Repeat. But the results are exponential. Third, use visualization techniques that make exponential growth feel more real. Don't just imagine having more money in retirement. Imagine the specific life that money will enable. Imagine the freedom, the choices, the security. Remember Dr. Hirschfield's research. The more real you can make your future self, the more likely you are to make decisions that benefit that future self. Fourth, reframe compound interest as compound freedom. Your linear brain might not get excited about mathematical growth, but it can understand freedom. Every dollar you invest today is a dollar working to buy your future freedom. And finally, embrace what I call exponential humility. Accept that you cannot predict or control the timing of exponential results. You cannot make compound interest work faster through effort or intelligence. You can only give it what it needs: time and consistency. This humility is actually liberating. It means you don't need to be the smartest person in the room. You don't need to time the market perfectly. You don't need to find the next big investment opportunity. You just need to start, stay consistent, and let exponential growth do what it does naturally. The compound effect on behavior. Here's something fascinating that most people miss about compound interest. It doesn't just compound your money, it compounds your behavior. Every month you successfully invest, you're not just adding to your account balance. You're strengthening the neural pathways associated with delayed gratification. You're training your brain to value future rewards over immediate pleasures. This is why wealthy people often seem to have different personalities around money. It's not that they were born different. It's that years of exponential thinking have literally rewired their brains. Neuroscience shows us that repeated behaviors create stronger neural connections. Each time you choose to invest rather than spend, you're making that choice slightly easier the next time. Each time you resist checking your account balance obsessively, you're building patience as a mental muscle. This creates what researchers call a positive feedback loop. Good financial behavior leads to better results, which reinforces the behavior, which leads to even better results. But the opposite is also true. Each time you cash out investments early, you're strengthening the neural pathways associated with impatience. Each time you chase get-rich-quick schemes, you're training your brain to devalue long-term thinking. This is why financial education alone isn't enough. Knowledge without behavioral change is just interesting information. You need to actually practice exponential thinking until it becomes automatic. Think of it this way. Compound interest isn't just a financial strategy. It's a form of cognitive behavioral therapy. It's training your brain to think in longer time horizons, to value patience over urgency, to trust in processes rather than demanding immediate results. The wealthy don't just have more money. They have different mental habits around money. And those habits were developed through years of practicing exponential thinking. The social psychology of exponential wealth. There's another psychological barrier we haven't discussed yet. The social pressure against exponential thinking. Our culture celebrates linear achievement. We admire the entrepreneur who works 18-hour days. We respect the athlete who trains harder than everyone else. We praise the student who studies more to get better grades. But we don't have cultural narratives that celebrate patience. We don't tell inspiring stories about people who got rich slowly through compound interest. We don't have heroes whose superpower was consistency over decades. Instead, our financial heroes are day traders who made millions in months, entrepreneurs who built billion-dollar companies in years, or investors who found the next Amazon before anyone else. These stories, while true, create a distorted perception of how wealth actually works for most people. They make exponential patience seem boring, passive, almost shameful. This social pressure is reinforced by the financial media, which needs to create content every day. Man continues to invest in index funds for the 847th consecutive month isn't a compelling headline. Local investor discovers stock that could return 1,000% gets clicks. So we're constantly exposed to stories about active, exciting, fast ways to build wealth, and rarely hear about passive, boring, slow ways that actually work for most people. This creates what psychologists call social proof bias. We assume that what we see most often must be the best approach. Since we see more stories about active investing, day trading, and entrepreneurship, we assume these must be better strategies than passive investing. But frequency in media coverage doesn't correlate with effectiveness in wealth building. In fact, it often correlates inversely. The strategies that get the most attention are often the least reliable. Compound interest gets ignored precisely because it works quietly, consistently, without drama or excitement. It doesn't create compelling stories because the story is always the same. Invest regularly, wait patiently, become wealthy slowly. This is why building wealth through compound interest requires not just financial discipline, but social courage. You have to be willing to pursue a strategy that seems boring to others, that doesn't generate exciting stories at dinner parties, that doesn't make you feel like you're making things happen. You have to be comfortable being unremarkable in your methods while pursuing remarkable results. Summary. Embracing exponential reality. We've covered a lot of ground in our exploration of exponential psychology. Let's bring it all together. Your brain evolved for a linear world, but wealth grows exponentially. This mismatch isn't a bug in human psychology. It's a feature that kept our ancestors alive. But what helped them survive can keep you from thriving financially. The key insights we've discovered. Linear thinking makes compound interest feel impossibly slow, when it's actually impossibly powerful. Your brain cannot intuitively grasp how small amounts of money can become large fortunes over time. Exponential growth requires exponential patience, exactly the kind of patience that feels unnatural in our instant gratification culture. But this patience can be developed through practice and proper mental frameworks. The compound interest blind spot causes people to focus on contribution size while ignoring time's contribution. Starting earlier with less money often beats starting later with more money. Exponential disbelief makes compound interest feel unfair or too good to be true. Our sense of justice says effort should equal reward, but exponential reality says timing and patience often matter more than effort. The linear trap causes people to overestimate risky alternatives while underestimating reliable compound growth. Active strategies feel more controllable, but are often exponentially riskier. Social pressure reinforces linear thinking because our culture celebrates active achievement over passive patience. Building wealth through compound interest requires social courage as well as financial discipline. But here's the beautiful truth hidden in all this psychology. Once you understand these biases, you can work with them instead of against them. You don't need to become a different person. You don't need to rewire your entire brain. You just need to recognize when your linear instincts are leading you astray and have systems in place to keep you on the exponential path. Remember that penny we started with, doubling every day for a month? Your brain's first instinct was to take the $1 million instead. That instinct isn't wrong. It's just optimized for a different world than the one we live in. In the world where your brain evolved, taking the certain million would have been the smart choice. But in our modern financial world, understanding exponential growth is the difference between financial struggle and financial freedom. The most successful investors aren't the smartest or the hardest working. They're the ones who learn to think exponentially in a world that teaches linear thinking. They're the ones who learn to see compound interest not as slow progress, but as inevitable wealth. They're the ones who learn to value patience over excitement, consistency over cleverness, and time over timing. Most importantly, they're the ones who learn that the most powerful force in wealth building isn't intelligence or effort or luck. It's simply understanding how exponential growth works and having the patience to let it work for you. Your linear brain will always prefer the $1 million today over the penny that becomes $5 million tomorrow. But now you know something your brain doesn't. In the exponential world of compound interest, the patient penny always wins. The frequencies embedded in this audio will continue working on your subconscious relationship with money and exponential thinking, even after the words end. Your mind is already beginning to process these concepts differently, to see compound interest not as an abstract mathematical concept, but as a reliable path to financial freedom. As you move forward, remember that exponential thinking is a skill, not a talent. Like any skill, it improves with practice. Each time you choose to invest rather than spend, each time you resist the urge to check your account balance daily, each time you stay patient when others are chasing quick returns, you're strengthening your exponential mindset. The linear world will continue to pull at you. There will always be new get-rich-quick schemes, new investment fads, new reasons to abandon the patient path of compound interest. But now you understand the psychology behind these temptations. You know why your brain finds them appealing, and you know why exponential patience is more powerful than linear action. Your future self, the one your brain doesn't quite recognize as real, is counting on the decisions you make today. And compound interest is waiting to transform those decisions into the financial freedom you deserve. Let it work. Give it time. Trust the process. Your exponential future begins now.